So today we are going to be doing chapter 10, part 1. And the first part of chapter 10, which is what we're going to be focused on today, is primarily about controls in the revenue process and then controls in the cash receipts process. So we're going to be talking about those a lot. And very quickly at the beginning of this chapter, we're going to go through the types of documents in the revenue process. I expect some of that to be a review or obvious, so I'm not going to spend a ton of time on it. Then next time in part 2 of the chapter 10 lecture, we are going to go over the substantive testing in the revenue process. And then we're going to spend quite a bit of time talking about AR confirmations, which is, of course, one of the key items that we test as part of revenue because it's our test of accounts receivable existence, which is also testing revenue occurrence. So this first slide in this chapter is completely intended to be review for you. So I'm not going to spend too long on it in terms of what it's supposed to be reviewing. It's supposed to be reviewing the basic rules of revenue recognition, which I believe you learned in your Intro to Financial Accounting course. So if it doesn't look familiar, dig those up. But basically, it's all these things like identify the contract, figure out the performance obligations, figure out the transaction price, and then you can finally recognize the revenue when you really satisfied your performance obligation, when you shipped those goods off, etc. So the first little slide we're going to talk about is fraud risks in revenue recognition, because the way this chapter is set up is kind of organized like the audit risk model. Okay, so it starts off talking about fraud risks related to this topic, revenue, and then it talks about some inherent risks for revenue. And then it talks about controls we consider in revenue. So that's kind of like control risk. And then obviously after you do that first part of the risk assessment, right, you determine risk of material misstatement, and then you know how much substantive testing to do. And substantive testing is the back end of the chapter. So we'll see that. So the very first part is, let's talk about some fraud risks in revenue recognition. Right, so to give this some context, when we talk through these fraud risks, let's think about if I am a manager in a big corporation and it is December, right? So it's getting very close to year end, and in December, I discover that I am going to fall short of this year's revenue targets, right? And I know if I fall short of this year's revenue targets, that I am not going to get my bonus. So in other words, I need to make sure that we hit our revenue targets no matter what. Okay, so I'm going to start pushing to make sure we hit those targets. So what are some things that I can do? Well, I can maybe set up some side agreements. That would be number one. So a side agreement could be me calling up a few of my best customers, and I start to give them some preferential terms or preferential treatment to get them to buy some extra supply this year, and then it'll be counted in this year's revenue. Okay, so the idea there is, right, I call them and I'm like, okay, I'll give you 20% off or 30% off, some really great deal if you take some of this excess inventory off my hands in the next couple of weeks, and I can recognize that sale as part of December's revenue, and I can hit my goals. Right? So you're giving just these special bargains or special agreements to certain customers to help get this inventory off your hands, extra inventory, get this extra revenue on my books, and make sure you hit those targets. Okay, so this could kind of be a side agreement situation. And again, that's not explicitly fraudulent or anything. It's just not a practice that's very sustainable, right? And when I say it's not sustainable, I mean you can't keep using that practice forever, because in January and February, those same customers aren't going to want to buy anything from you because they're all stocked up from this extra stuff that they bought in December, right? So now January and February sales are going to fall short. Q1 sales are going to fall short. And what are you going to do then? You're going to be back in this kind of rat race trying to come up with more tactics. Okay, so then next we have channel stuffing, which is pretty similar. Channel stuffing is specifically me trying to get my customers to buy as much as possible. And generally when we say stuffing, it's more than they need and it's more than they can possibly use, right? And so it's stuffing because my customers are like my channels through which I sell things, right? And you want to keep, your channels running smoothly, running clean, and you're kind of like stuffing your channel, right? So you're stuffing it, and because I'm stuffing it, naturally it's gonna start to overflow, right? So again, it's not a sustainable practice because I'm selling them so much stuff so fast, right? I'm trying to get all these sales out the door in December. And so when next year comes, January, February, March, they don't want to buy anything from me because they're all stuffed up for the next year or two. And so with channel stuffing, it's just a really extreme version of this. Like you sell them in December, I sell you like 2 years worth of stuff. So now next year, they want nothing to do with you. And the problem with channel stuffing, again, not a sustainable practice. They won't want to buy from you next year. It can also lead to really high returns in the next period. So maybe in January and February, now you're seeing really high rates of return or unusually high rates of return. And again, it's just going to kill you in these future periods. I think you guys are already very familiar with issues with related party transactions, so won't necessarily go into that. And bill and hold sales, this is essentially when I sell people inventory or sell customers inventory, and I go ahead and recognize revenue, but I do not actually ship the inventory to the customer, right? And we know the obvious problem with this is it clearly violates this last revenue recognition requirement that says I have to have satisfied my performance obligation, right? I should be transferring my goods and services. So that's not happening here with the bill and hold scheme because I haven't actually transferred anything, right? Literally all I have done in a bill and hold scheme is said, sure, I'll sell you that, and I billed you, right? But I have actually done nothing in reality to fulfill my side of the bargain. And this slide is really review. It's just a reminder of all the different accounts that can be impacted by the sales revenue process. So remember, sales is just the first part of it. Then we have all the cash receipts and all the accounts that affects. And you have to think about things like sales returns, bad debt expense, and all that good stuff.